A fixed deposit is a financial instrument provided by banks which provides investors with a higher rate of interest than a regular savings account, until the given maturity date. It may or may not require the creation of a separate account. It is known as a term deposit or time deposit in Canada, Australia, New Zealand, and the US, and as a bond in the United Kingdom. They are considered to be very safe investments. Term deposits in India is used to denote a larger class of investments with varying levels of liquidity. The defining criteria for a fixed deposit is that the money cannot be withdrawn for the FD as compared to a recurring deposit or a demand deposit before maturity. Some banks may offer additional services to FD holders such as loans against FD certificates at competitive interest rates. It's important to note that banks may offer lesser interest rates under uncertain economic conditions. The interest rate varies between 4 and 11%. The tenure of an FD can vary from 7, 15 or 45 days to 1.5 years and can be as high as 10 years. These investments are safer than post office schemes as they are covered by the Deposit Insurance and Credit Guarantee Corporation. However, DICGC guarantees amount up to the first 1,000,000 per depositor per bank. They also offer income tax and wealth tax benefits. Explanation: fixed deposits are a high-interest yielding term deposit and offered by banks in India. The most popular form of term deposits are fixed deposits, while other forms of term deposits are recurring deposit and flexi-fixed deposits. To compensate for the low liquidity, FDs offer higher rates of interest than saving accounts. The longest permissible term for FDs is 10 years. Generally, the longer the term of deposit, higher is the rate of interest, but a bank may offer lower rate of interest for a longer period if it expects interest rates, at which the central bank of a nation lends to banks, will dip in the future. Usually in India the interest on FDs is paid every 3 months from the date of the deposit. The interest is credited to the customer's savings bank account or sent to them by check. This is a simple FFD. The customer may choose to have the interest reinvested in the FD account. In this case, the deposit is called the Cumulative Fd or Compound Interest FD. For such deposits, the interest is paid with the invested amount on maturity of the deposit at the end of the term. Although banks can refuse to repay FDs before the expiry of the deposit, they generally don't. This is known as a premature withdrawal. In such cases, interest is paid at the rate applicable at the time of withdrawal. For example, a deposit is made for 5 years at 8%, but is withdrawn after 2 years. If the rate applicable on the date of deposit for 2 years is 5%, the interest will be paid at 5%. Banks can charge a penalty for premature withdrawal. Banks issue a separate receipt for every FD because each deposit is treated as a distinct contract. This receipt is known as the fixed deposit receipt, that has to be surrendered to the bank at the time of renewal or encashment. Many banks offer the facility of automatic renewal of FDs where the customers do give new instructions for the matured deposit. On the date of maturity, such deposits are renewed for a similar term as that of the original deposit at the rate prevailing on the date of renewal. Income tax regulations require that FD maturity proceeds exceeding Rs 20,000 not to be paid in cash. Repayment of such and larger deposits has to be either by AC pay cross-check in the name of the customer or by credit to the saving bank AC or current AC of the customer. Nowadays, banks gives the facility of flexi or sweep an FD, wherein you can withdraw your money through ATM, through check or through funds transferred from your FD account. In such case, whatever interest is accrued on the amount you have withdrawn will be credited to your savings account and the balance amount will automatically be converted in your new FD. This system helps you in getting your funds from your FD account at the times of emergency without wasting your time. Some benefits of FD: customers can avail loans against FDs up to 80 to 90% of the value of deposits. The rate of interest on the loan could be 1 to 2% over the rate offered on the deposit, and resident of India can open these accounts for a minimum 3 months. Taxability: tax is deducted by the banks on FDs if interest paid to a customer at any bank exceeds Rs 10,000 in a financial year. This is applicable to both interest payable or reinvested per customer. This is called tax deducted at source and is presently fixed at 10% of the interest. With CBS, banks can tally FD holding of a customer across various branches and TDS is applied if interest exceeds Rs 10,000. Banks issue Form 16A every quarter to the customer, as a receipt for tax deducted at source. However, tax on interest from fixed deposits is not 10%. It is applicable at the rate of tax slab of the deposit holder. If any tax on fixed deposit interest is due after TDS, the holder is expected to declare it in income tax returns and pay it by himself. If the total income for a year does not fall within the overall taxable limits, customers can submit a Form 15G or Form 15 hours to the bank when starting the FD and at the start of every financial year to avoid TDS. How bank FD rates of interest vary with central bank policy. In certain macroeconomic conditions, a central bank adopts a tight monetary policy, that is, it hikes the interest rates at which it lends to banks. Under such conditions, banks also hike both their lending as well as deposit rates. Under such conditions of high FD rates, FDs become an attractive investment avenue as they offer good returns and are almost completely secure with no risk. See also, recurring deposit, time deposit, deposit, references. External links, corporate fixed deposits, fixed deposit.